All right, so I think we can get started. Good morning, and thank you for joining today's webinar titled Navigating the Green Horizon, Exploring Carbon Credit Markets. I'm Marcel Bluhm, Director of Research Reports at the blog, and it's my honor to host today's discussion. Carbon credits are a critical tool in the global effort to mitigate climate change, providing a tangible measure and financial incentive for reducing greenhouse gas emissions. I'm pleased to introduce our expert panelists who will discuss this topic. They are Natalia Dorfman, the CEO of Kita, Andreas Merkl, the CEO of Centigrade, Hayley Moller, the CMO and member of the founding team at Thallo, and Peter Rosberg, who is product and engineering lead at Ripple. Today's agenda is divided into three main segments. First, we will kickstart with a self-introduction by our panelists and a brief overview on the essence of carbon credits in climate action. Second, our main discussion will evolve around market dynamics, technology and innovation, as well as regulation and risk management. Third, we will look at the future outlook and market trends. Lastly, we will wrap up with a Q&A session. I'm excited for an insightful discussion over the next 60 minutes. I would like to give a special thanks to Ripple for sponsoring this event. Feel free to drop your questions in the chat for the Q&A session later. Now, without further ado, let's kick it off with a brief self-introduction from our esteemed panelists. Natalia, can you please go first?
Yes, of course. Thank you very much for having me. I'm Natalia Dorfman. I'm the CEO and co-founder of Kita. Kita is an insurance company. We specialize in insuring transactions in the carbon markets. Our specific focus is on delivery risk, so ensuring the buyer or the investor who's putting money into a carbon project and protecting against the risk that they don't receive verified carbon credits. And we're always looking at how do we help to identify and manage the risks in the carbon market such that we can hopefully enable more flows of finance to go to help scale the high quality carbon projects.
Thanks, Natalia. Andreas?
Hello, everybody. Andreas Merkl. Thanks so much for having me. I'm CEO of Centigrade. We are a startup. We are building a basic and fundamental data utility for the entirety of the carbon market, which is completely transparent and has the ability to track the performance of credits across time, hopefully allowing for price discovery along the way, and bringing money into the carbon development cycle much earlier than is possible in the current system. My background is I've been on the intersection of climate and finance basically my entire professional life. And most recently, though, I took a detour of that, and I was the CEO of Ocean Conservancy for a while.
Thanks, Andreas. Hayley?
Yeah, fabulous. Thank you, Marcel. Super excited to be here today. My name is Hayley Moller. I have spent about 16 years in the climate and sustainability space, the bulk of which was in climate change communications. So I spent a lot of time working with folks like Al Gore and Project Drawdown and C40 Cities, looking to help folks understand the urgency around acting on the climate crisis. I got an MBA at INSEAD a few years ago, and that led me to where I am now, which is the CMO and part of the founding team at Thallo. So what is Thallo? Thallo is a climate solutions company, and we're providing access to the entire carbon market. We have launched our first product, which is our Carbon as a Service API, little play on software as a service there, which businesses can use to embed high quality carbon credits into their existing products and services. So it's a single access point for millions of carbon credits, all of which are transparently secured on the blockchain. So we work with carbon project developers to make their credits available through our API To do this, we built some pretty cool technology. We built the world's first two-way carbon bridge, which is essentially a piece of technology that integrates directly with carbon registries and allows us to bring carbon credits onto, and if needed, off of the blockchain. So super excited to be here. I always like to say we're a climate tech company that happens to use blockchain technology, and I'm a climate person that happens to be here talking about technology today, which is super exciting, and excited to dive in.
Thanks, Hayley. Great to have you. Peter?
Hi, I'm Peter Rosberg. I've been in fintech for about 25 years, so I've seen a lot of interesting things in Silicon Valley in a variety of engineering and product roles. Most recently, I've been at Ripple for 5.5 years, and the past 2 years of my tenure at Ripple, I've focused specifically on climate and the carbon markets. And Ripple's been really leaning into helping address the climate crisis and sustainability. And I personally work with the XRPL Grants Committee evaluating project proposals in the sustainability space. And I also directly help projects and developers leverage the XRPL to create innovative projects that address climate change and sustainability problems.
All right, so thank you for providing your backgrounds, and let's dive in. So first, I would like to set the stage and ask you to give us some general perspective on the role of carbon credits in climate action. So why are carbon credits essential for climate action? Let's start with you, Peter.
We need all the tools in our toolbox to help fight global warming. There's been a lot of news in the press about whether carbon credits are valid or essential for addressing the problem, but quite frankly, everything needs to be thrown at the problem. Carbon credits, whether they're insets, addressing existing scope 3 emissions of companies, or offsets to help offset a company's emissions. We need everything to help reduce and remove our impact on climate. Carbon credits also are a unique way to provide a carbon accounting mechanism that we can leverage using science-based targets to achieve our goals. So super important.
Thank you, Peter. And Natalia, do you want to go next?
Yeah, sure. And I'll echo a lot of what Peter said. I'll just give some maybe slight context into my background. Prior to Kita, I spent 15 years in the legal industry, and my last job, I was global head of new business at a law firm, and I led the business development strategy for the firm's climate risk practice. And so I used to speak with a lot of large corporates in terms of how they were looking at net zero across multiple facets, including the carbon markets. And I'll say, actually, I used to be more of a skeptic on the carbon markets. I saw some of the aspects of companies that were looking not to reduce, but instead to offset their way. I actually think that has changed quite a lot in terms of that mentality. And the way that I came back to the carbon markets was really via looking at, we knew we wanted to use insurance as an enabler to drive more finance to scale, high quality climate solutions. But we started thinking around, how do we use insurance as an enabler to help value nature? And once you start looking at it from that perspective, the carbon markets are really the existing tool we have at our disposal to really push flows of finance into nature that both can capture carbon dioxide, but also can improve biodiversity. Further to that, we now also very much look at the carbon removal space within the carbon markets. And I think we all know that carbon removal is key to the net zero. When we talk about net zero, we don't say zero emissions, we say net zero emissions. And so that is inherently recognizing that, well, there will be some unavoidable emissions that continue, and we need to be looking at how do we remove those from the atmosphere such that we can meet climate targets. And so I truly think that the carbon markets are essential to that, and they're not perfect, but they are a tool that we can use to drive finance to do some very essential things.
All right, thank you. Andreas?
Yeah, well, if we look at the global load here, it depends on who you believe, but it's sort of the estimates go from $5 to $9 trillion. a year, what we have to do for the next 30 years to get to 2.0. That's 5 to 9% of global GDP. And if you look at where that money is going to come from, you could say, well, half of that will come from just the normal course of industrial asset turnover, and that's covered by corporate finance, and it's covered by project finance. And then some of it is going to come through taxation from you and I, and it's going to be public finance, right? And those two together, they may even be 70% of that, right? Which just leaves us with more than $1 trillion a year on finance that has to come through a third vehicle, which is the market. And the market is pretty darn good at allocating capital to highest and best use if you give it the right regulatory framework, right? And so we've got to have that. And as Natalia said, it just so happens that most of that $1.5 trillion goes to things that have no other natural finance source anyway, which is called nature. Right? We haven't integrated nature perfectly into our economy, so this is what we've got. And the last angle is fairness. We have stiffed the global south on the last 15 years on $100 billion per year promise that was made on public finance, climate finance, transfer from north to south. They have seen very little of that, and what they've seen was an additional, right? If we cut down on the carbon markets now, we're basically shutting out the other side, which is the private finance to them as well. It would be catastrophic. We can't do that.
All right, thank you. And Hayley?
Sure. Yeah. Hard to go last because there's not much to say that hasn't already been said. And I think I was nodding enough that I might knock my own head off, but especially including to Natalia's point about being a bit of a skeptic about the carbon markets coming in initially. I studied environmental science. I look at the numbers. I look at the data. Maybe what I can add here is just a couple of points from the science standpoint, which is first, there is IPCC research, which for those that don't know is the global body of many scientists all around the world who agree on the climate science that we look at. There's IPCC research that shows that the top 5 levers to meet the global carbon budget are all areas that carbon credits actually address. So they're renewables, reducing destruction of natural ecosystems, sequestration in agriculture, ecosystem restoration, and a couple of others. But these are all areas that carbon credits actually directly address. So to Andreas's point, getting financing to those communities that might not otherwise get financing. And then separate IPCC research shows that we actually do need to remove carbon from the atmosphere. So not just stop emitting carbon, but remove carbon that already is in the atmosphere and go beyond net zero to reach the aims of the Paris Agreement. And that's carbon removal credits, right? So I think there's a really strong scientific standpoint, for why we need this market. And then the last piece, and Natalia, you touched on this a bit, about how these concerns around companies using carbon credits in lieu of other decarbonization efforts, that really isn't the case anymore. And there's some really good recent data out from Trove Research and Ecosystem Marketplace that both separately found that companies that buy large amounts of carbon credits, material amounts of carbon credits, actually decarbonize 2 times as fast as those that don't. So I think that the data is right there that shows that we don't have to be super concerned about this potential for greenwashing, because these companies actually are moving towards decarbonization and not just using this market as a crutch.
Let me just echo that actually, because I don't know if I got across when I stated that. It's not a concern that I currently have anymore. I'll echo what Hayley said. I think the conversation has moved on, and I have clearly become a carbon markets convert.
Likewise.
All right. Thank you so much for those insights and giving us the backdrop. So let's shift the focus towards our main discussion, starting with market dynamics. So markets play a crucial role in price discovery to bring demand and supply into equilibrium and to bring financing for projects that can result in carbon reduction. So can you discuss the current market dynamics of carbon credits, focusing on issues such as supply-demand balance, price stability, and market efficiency? Hayley, can you start with that one?
Sure. Yeah, I'll kick it off, and I'll make sure to leave some for everybody else to talk about too, because there's a lot of ground to cover here. First and foremost, right now, we do see an imbalance between supply and demand. And that's because demand has cooled down quite a lot. The last couple of years saw a lot of new purchasing in the market, and demand was increasing significantly. And because it takes carbon credits several years in many cases to get to market, a lot of folks came into the supply side of the market to be ready for that demand that was projected to grow exponentially in the next few years. So there's a rush into the supply side, and at the same time, we've had this cool down on demand. And this cool down largely has come from a few key areas, in my opinion. One is around concerns around quality. Quality has become kind of the word of the day in the carbon markets. However, there's no one definition of what that means. And so that makes it difficult for suppliers to meet quality standards, since there really aren't clear quality standards at the moment. And then it makes it hard for buyers to know that they're buying high quality carbon credits. And as Peter alluded to earlier, there has been some very high profile media criticism of the carbon markets earlier this year. And that has really frozen a lot of that demand from companies that don't want to get into a situation where they have reputational risk due to carbon credits that they've bought. However, there's a lot of folks working to try to improve that issue around quality. We have seen rating agencies like Solvera and B0 crop up, folks like Kita that are doing insurance for carbon credits. And really crucially, there are two big bodies that have been trying to tackle this issue. One is the Integrity Council for the Voluntary Carbon Market, which attempts to address quality from the supply side. So essentially setting base standards, minimum standards for what they call the core carbon principles. So these need to be met for a minimum threshold for quality. And on the demand side, the Voluntary Carbon Markets Integrity Initiative, or VCMI, which attempts to give guidance to the demand side on what are good carbon credits to buy. But there's a lot of time that goes into these standards and public review processes and consultations. So neither of those is 100% solidified at this point. And so I think we'll continue to see some hesitation from the buy side of the market in particular as these more standard definitions of quality come into effect. I'll maybe leave it there. There's a lot around opacity and fragmentation of the market that a lot of us are all working to try to improve upon. And I know that's where a lot of the blockchain solutions have come from, is trying to make this market more transparent, more traceable, and ultimately more efficient. But I'll let the other panelists weigh in on those topics and others.
Thank you, Hayley. Andreas, you want to take the next?
Sure, happy to. Where does one begin? The functions of the current market, it's diminutive, right? It's somewhere between 500 million and $2 billion right now, which is that's the flapping of butterfly wings compared to the problem. There's a lot of talk. Everybody says the same thing about it's a lack of transparency and a lack of trust and a lack of price discovery. But I think we need to bring it down a little deeper to the structural problems that this market has. I mean, it's a public purpose market, really, right? It exists for a purpose, and that purpose is not necessarily greed driven. It is publicly driven, and we don't really know how to do this. So it's hard. Let's just realize it's hard. But the current market, I think, has three structural problems. The market structure is wrong, the asset classification is wrong, and the information environment is wrong. So the market structure, this market is a private market, over-the-counter spot market. It's not a public market like a bond market or so on. Private markets don't scale very well. They have huge asymmetries in data. It's easy to do profiteering. It's very hard for buyer and seller to get together. There's rampant insider trading. Public markets, insider trading will get you in jail, right? They're markets built on transparency and on structural transparency, where nobody is allowed to build a walled garden of proprietary information about an asset and then trade on that basis. And that behavior is rampant in today's market. So that's structural problem number one. Number two is on the asset class. We're treating these credits as if they were a commodity. You buy it once and then the price stays the same except for the vagaries of supply and demand, when instead, of course, it's a lot more like a bond, right? The price of a credit should change over time commensurate with its performance. Makes sense, right? And it doesn't right now. The infrastructure to do that, we don't have a floating price, a performance-driven floating price in the market. That's terrible for a market. The third thing is that we are obsessed with, on the information side, that we're obsessed with credit quality when we should be obsessed with data quality. If we're going to have a market, for Christ's sakes, let's have a market. Right? Markets know how to differentiate between junk bonds and AAA bonds, right? If Andreas has sells something, sells crap to Marcel, and Marcel knows it's crap, then we have a trust-based relationship, right? That's how markets work, and we're not allowing the markets to work. But the way that we've done it is we've said only AAA credits are allowed in the market, and that's led to all kinds of gaming and problems and access issues. So there's a big structural stuff going on that we need to fix.
Okay, thanks, Andreas, for that. And Natalia, do you want to chime in on that?
I feel like we could probably focus the whole conversation on that. I think that's Andreas made some very, very good points. I won't elaborate too much on them further, other than to agree that I think it is in a commodities market. It is more akin to a bond market, whether or not it needs to exactly echo the bond market or over time form its own kind of thing. But the direct comparisons to the commodities market, it can be challenging because it, at the end of the day, is in a commodity. And the fungibility aspects are a whole other conversation, which actually I could bring in here. So I guess in terms of market dynamics, a few points. So to echo what Hayley said, I think, yes, the demand has certainly cooled. One thing, though, that I do find interesting, and I think some reports from Trove and Debatable, I think, have come out recently demonstrating that actually the amount of investment still going into the project is about 5 times greater than the amount of carbon credits currently on the market. And I say from Kita's perspective, because we do engage with investors and buyers who are really forward purchasing, we're looking at that really early stage investment. We see a lot of that investment going in. I will not say it is easy. Obviously, these deals are undergoing a lot of due diligence. I think the length of those investment processes has expanded greatly. They are taking a lot longer than they used to do. And likewise, the structure of the investments is changing. So you still, of course, are seeing bilateral contracts, but you're also seeing more forms of structured financing being developed. That leads, I suppose, to another market dynamic, which are the contractual structures that we've seen within the market. I think we've talked a little bit about the lack of data transparency. One of the ways that I think that manifests is the lack of standardized contracts, both in terms of pushing risk onto an entity in the chain somewhere, and sometimes that entity might not be the most well placed to handle that risk because of the lack of standardized contracts and the lack of standardized acceptance of where certain liabilities lie. Sometimes that liability is pushed around and it doesn't necessarily end up with the best person or company, and that can impede flows of financing. Of course, that's where insurance can start to come in and play a role, but insurance would prefer for a standardized contractual form to already be agreed rather than to sort of work within a moving space. But I do see shifts in the forms of financing and therefore shifts in the ways that these contracts are structured. A lot of these shifts are looking to have some form of end buyer certainty, which again comes back to the demand point. If you're looking at setting up some kind of structured financing where you, at the end, you already have a pre-agreed off-taker, and there's only a limited number of off-takers out there, that again is another point that slows down the financing structures. But I do see a lot of financing going into the market. And so I think that once that starts to come out the other side, we'll be seeing a good number of projects getting off the ground. And hopefully that will then translate to demand coming back, because at the end of the day, we still have a shortage of supply when you look at the actual requirements of companies from 2030 onwards.
If I can just add one thing on there, because I think that's spot on. We did some research last year with project developers, asking them what is the delay for them, what is causing their limitations to scaling. And the two things that came up over and over again were getting early stage financing for their first check into the project. That was a key one. And then delays in the verification process was another piece of that. So, it takes on average 1.5 to 6 years to get those credits issued. It costs upwards of $100,000 to go through that process. And those are pretty big barriers to get more projects out of the gate. So I think those are key structural elements on the supply side to note.
All right. Yeah. Thanks, Natalia and Hayley. Peter, what are your insights on this?
Wow. Great insights already. And I think maybe I'm going to go a little off program, and instead of responding too much, since I think everybody's covered it really well, I'm going to back up and maybe explain a couple things for the Web3 people that are watching this that might not know the assumptions that we're making as we're saying all these statements. And so when we say this isn't it's difficult to compare this to a commodity, a lot of people in the non-sustainability world go, well, it's a carbon credit. It all has the same value, right? It's 1 ton of CO2 being sequestered. But in actuality, this carbon credit has many things that impact its price, right? And that's where we get this price asymmetry that Andreas is talking about. And that price is impacted by additional co-benefits by the year that the credit was created. So co-benefits would be like, is it an equitably created credit? Are you working with indigenous populations? Are you impacting the water or the soil when you're doing this? Are you doing a monocrop of the same tree, or you're actually using a proper methodologies for promoting biodiversity? So that's what we mean by that's, it's not a commodity. In addition to that, it's priced usually based on the vintage, meaning what year that credit was produced. So if I'm buying a carbon credit that was actually produced in 2012, is that even valid anymore? We've got to have some sort of expiration date on the validity of those credits. And then finally, one more definition. Andreas was talking about like this should be priced more dynamically like bonds. The way sustainability and carbon credits work is you have to figure out what your baseline is, right? And so when we calculate the values of these carbon credits, we say, well, what if I didn't do anything? How much carbon is already being sequestered by this maybe, agricultural former livestock feeding field that I'm going to convert back into a biodiverse agroforestry project. So you figure out the baseline to say how much carbon was already sequestered and how much more you're going to sequester. But then what happens next year or the year after that or the year after that? How is that project performing in keeping that agroforestry project going? How is it performing on its co-benefits? Is the indigenous population that is supporting that agroforestry project still getting properly compensated for that land and the work that they're doing on the land? And so all that comes into what's called dynamic baselining, where you can actually say, okay, what is it worth now versus what was it worth before? Natalia can probably tell you about all sorts of great products she has to ensure that that if something happens, like the forest burns down or some other, event happens that reduces the value of that, those credits based on doing that additional reporting and baselining happens, you can offset the impact of that. But those are all key things that you should understand as we're talking about these market dynamics.
Thanks, Peter, for providing those informations. And so that shows that probably data and technology are super important to track all these things to get the baseline. And so that will be the next discussion point we tackle. So technology and innovation. Carbon credit markets can make use of a lot of new technologies like the Internet of Things, blockchain, and AI. So how are emerging technologies like blockchain and AI shaping the carbon credit market, especially in terms of data and asset management? Peter, let's go on right away with you on this one.
Great. I think I gave a great segue into myself on talking about dynamic baselining and MRV. Wasn't intentional, but I think it worked out. Yeah, there's some amazing stuff in the intersection of blockchain and AI that I think we're in an inflection point where we can provide a lot of tools to these projects. So first, one thing that really gets me excited is how do we level the playing field for some of these smaller projects? They need to have the tools. You've got these large governmental projects or big, well-financed projects, but how do you level the playing field for like smaller, projects that are just happening, directly being produced by these, farmers in Colombia? And one of the ways you can do that is by providing an open network where you can share data freely and anybody can access it, on chain, blockchain, allow free storage of data and information that anybody can inspect. Really helps level the playing field. Provide tools on top of that. I'm working with a number of developers to help provide these tools and make it much easier for these projects to upload information on chain, and then track and create, dashboards and reports on like who's buying what credits and how valuable are they and how impactful are they. In terms of AI, I think we're just starting to scratch the surface on how a lot of AI is going to impact this work. One of the most important things for projects is measuring, reporting, verification. It's called MRV, right? And the impact on AI is already happening for the measuring and verification pieces. So there's drone software now where you can analyze satellite imagery and drone imagery to see what the forest canopy is for the diverse, analyzing the diversity of the ecosystem and what trees are there that are sequestering what amount of carbon. There's starting to be some real cool biodiversity measures where they're just hanging microphones in forests to analyze bird song or other noises to figure out what the biodiversity is. And then finally being able to crowdsource people, on the ground doing data collection with their phones and, helping set up remote sensors where you can now easily aggregate that data and then turn that into meaningful reporting information by taking this huge amount of data and distilling it down into the things you need to provide science-based backing of methodologies that are supporting how much biodiversity you're increasing in the area or carbon you're sequestering with the forest canopy.
Fascinating stuff. Hayley, can you provide your insights on this technology, from this technology and innovation angle?
Yeah, absolutely. So I think Peter did a good job of giving some really concrete examples, especially in the MRV space. Some other areas that also these technologies can be really instrumental for, and I'm partial to blockchain because that's the area that we work in, and because I see the direct benefits that can come from it. But specifically, you have kind of a whole life cycle or value chain that happens to generate a carbon credit. We talked about it a little bit earlier, but it starts with project design and really goes all the way through till a carbon credit gets issued and then transacted. And there's ways that these technologies are being implemented already across all of those areas. So from the beginning, there's some really interesting and creative ways of getting early financing to these projects. So there's organizations like Ivy Protocol and Green Trade and Solid World that have used Web3 tools to bring new sources of financing into these types of projects and getting them off the ground. As I mentioned, that's a key barrier to some of these projects. Peter talked well about the MRV, so the measurement, reporting, and verification process. A lot of the folks working in that space are aiming to reduce the cost to project developers, reduce the amount of time it takes to get these carbon credits verified, and also to increase trust in them by having this additional data, these additional data points, or ongoing monitoring through things like satellite monitoring, et cetera. Then you have the registry and issuance. So these are the verifiers of the carbon credits that actually issue the carbon credits to the project developer, who's then able to sell them. And we are working, so far, we've integrated with 3 registries. So Biocarbon Registry out of Latin America, Puro.earth, which focuses exclusively on removals, and Social Carbon, which is more focused on co-benefits projects. So we've integrated with these registries. They see the value in using blockchain technology to avoid double counting. So concerns that a carbon credit might get used in 2 places, and therefore only have half the benefit. And we are also working really closely with Gold Standard, which is sort of the leading carbon credit registry, to help them with their own processes and policies around tokenization of carbon credits. Then you have the B2B and B2C market services, which is really where Thallo comes into play. And what we're offering is, using an API tool and using the blockchain-based credits, giving super easy access to users of carbon credits. Once we have carbon credits on the blockchain, we're able to fractionalize them. So somebody can retire less than a ton of carbon. I don't know if we mentioned at any point, but every carbon credit is worth just 1 ton of carbon. And that's quite a lot of carbon. I mean, it's like 2 tons to do a round trip, coast to coast flight from New York to San Francisco, just to give you a sense. So if you want to just offset for a pair of shoes that you're buying or something like that, it's much less than 1 ton of carbon. So having this on the blockchain enables the accounting needed to be able to fractionalize these credits and retire less than a ton. And then also enables things like we will be launching a marketplace next year. And in the marketplace, if somebody buys a carbon credit and then trades it to someone else without retiring it, using it, spending it, then a royalty from that secondary trade will go back to the original project developer. So therefore allowing them to participate in these secondary trades. Thank you for the thumbs up, Andreas. It's so important to introduce fairness into this market. And then the last piece is around data and getting good metadata around these projects. I talked earlier about the ICVCM, the Integrity Council, that's putting out these core carbon principles. Once those get implemented, if you have a carbon credit on the blockchain, you can tag additional data to it. So if a carbon credit gets approved a registry gets approved as core carbon principle aligned, that's a tag that you can add retroactively to an existing carbon credit. Similarly, you can do things like tracking emissions, tracking tokenized emissions, and pairing them with tokenized carbon credits so that you have a one-to-one compensation for those emissions. So lots of good work being done in this space.
All right. Thank you, Hayley, for providing this additional color. And Andreas, would you like to add to this point from the technology innovation angle?
Yeah, sure. I mean, if you think about, let's go back to the bond market and think about the information hierarchy and infrastructure and taxonomy that is below every single bond that allows you to put a reliable and good and fair and efficient price on it, right? Just think about the incredible amount of the incredible information density that requires. Now let's go to the bond markets. It's worse yet. Right? So if you're thinking about hundreds of millions of credits, each one of these credits makes, let's say, 30 or 40 claims as to its performance, maybe more. And each of those claims has a stream of data over time attached to it. Performance data, is this tree really growing? Is the water really flowing? Is this thing doing what it said it would do? Is this claim really true? That needs to all be verified. So now you have 100 million times 30 times, I don't know how many constant data streams. So that's a lot. That's big data right there. And then you have all kinds of problems on top of that. You have the data come in with scalar differences, temporal differences. They come in as PDFs. They are not The data are not decipherable by armies of interns, right? We need to actually have an AI function to make sense of the incredible density and variety of data forms that are going to come in. So that's the AI angle. And we need the blockchain to facilitate the tracking over time. These are absolute key. I mean, the timing is really good. That at the time when we desperately need this, these technologies are now, available. It's quite amazing, just in time. But here we are.
Great points. So unless somebody has an additional comment, in the interest of time, I would move to the next area of discussion, which is on regulation and risk management. So my question here would be, what are the primary risks associated with the carbon credit market, and how can they be effectively managed? And then as an additional question, how are they addressed by compliance and regulation? So Natalia, I think this falls squarely into your area, so I will give you the first opportunity to respond to this.
Yes, of course, thank you. I would like to respond to this actually in sort of two macro points, and then I can go into some of the risk buckets that we look at, noting, of course, that we look at it from a very specific insurance standpoint of we are going to insure a project, and then if that the risk we're protecting against happens, we would pay out an insurance claim. And actually the data points that everyone was just talking about is very, very helpful, obviously, to insurance companies in order to do that underlying pricing and modeling that we need to do. But in terms of the two macro points, so one, there's the quality versus risk discrepancy that I talk to people a lot about. There's a lot of conversation in the carbon markets as to risk as specific to the quality or lack thereof of a carbon project, with the quality of a carbon project, broadly speaking, being discussed via carbon metrics like additionality. So would this project have happened anyway without the carbon finance? You need it to be additional, such that the carbon finance enabled the project. Leakage, like if I plant some trees here, is someone going to cut them down over here? The permanence or durability, so once the carbon is stored in something, how likely is it that it's going to be released, as well as the co-benefits that Peter already talked about. So these are the kind of quality standards within the carbon markets, and there are risks associated with a carbon project not meeting those quality standards. I will always say, though, the quality metrics of additionality, leakage, etc., are different than the risks that an insurance company would look at. So from Kita's perspective, we will only insure a project if we think it is a quality project. Like, we have no interest in insuring projects that we think are terrible. We're a very purpose-driven organization. But a quality project might not be insurable because it might be very, very high risk. So it might be a really new type of technology in a high-risk country, or something that just might not meet our underwriting criteria. Likewise, a low-quality project could be really low risk, but we just wouldn't insure it. So I always look at those things in two separate buckets, the quality versus risk. The other macro point here is sort of obvious within the carbon markets, but likewise, sometimes we don't touch upon it as much. There's a nuance between the physical asset, so the physical, say, trees that are capturing carbon, and then the intangible asset that comes off of the physical thing, so the actual ton of carbon dioxide that is captured and that is represented in a carbon credit. And again, the risks of these two things are different. And so the physical asset will be subject to physical risks from natural catastrophes to supply chain disruptions. The carbon credit might likewise be impacted by those things, but depending on how the contract is structured, how many safeguards were put into the carbon modeling, the carbon credit might not be impacted. So for example, if you look at a forestry project, when it does its initial carbon modeling, it might take into account the expectation that it has some fires across the following 5 years. If fires do occur, that is a physical risk that's impacting upon the project. But if they've already been modeled into the carbon forecasts, it might not actually cause a loss to the resulting carbon credits because the project has already taken that into account when it issued those credits. And so again, keeping those two things separate, and then from the insurance perspective, knowing what you're insuring. Are you insuring the physical risk to the physical thing, or are you insuring the carbon credits that are stemming from the physical thing? And then you need to look at other metrics there. Then in terms of the risk buckets that we tend to look at, these are high-level buckets for the sake of time. but we would look at counterparty risk. Like, this is a very important thing, and I think one that when we speak to people within the financial markets and buyers is very important, but isn't covered as much within the carbon markets. Like, who is my counterparty? Particularly if I'm investing in an early stage project and the project isn't going to provide me with carbon credits for maybe 5, 10, 15 years. Like, what is the likelihood that this counterparty is even going to be in business in 5, 10, 15 years? It might be a startup. Likewise, you might have fraud or negligence concerns, but like the counterparty risk, who is this entity and what kind of contractual arrangements do I have with them? You then have the resilience risk, which feeds into the physical part of the carbon project. So what is the likelihood of natural catastrophe risk is obviously a very big one, particularly when we're talking about nature-based projects and unfortunately climate change. With your more technological projects, particularly the newer technology, supply chain risk, for example, is a big one. If there's a machinery failure, you might actually be very restricted in getting a replacement part because there's not that many companies out there giving replacement parts. So things like that, the resilience of if something goes wrong, how do we enable that project to get back on its feet quickly? The political risks are relatively sizable. This goes into, I guess, the regulatory point, but there's, I won't get into Article 6, but there's consideration around the world in terms of countries and how they're going to treat their carbon assets. And within the insurance world, this would fit squarely into what you call political risk insurance, which is where the host country in which an asset is based could potentially say, we're going to keep this asset, which in insurance language would be expropriation. Or they might say, we're going to block the license of this asset to export its goods outside of the country. Or they might implement a change to revenue structure, so a tax to that project. And again, these are sizable risks within the carbon markets that are currently being worked upon in different countries. And that uncertainty of that risk is restricting some flows of investment. That's another way that insurance can play in. Two ones I'll say quickly is delivery risk. A lot of these projects are receiving their CapEx today. They're not going to be delivering their carbon for many years. This is a bit of a macro risk that encompasses many of those sub-risks, but what's the likelihood the project will actually meet its forecasts? And then finally, the usage risk. So again, going a bit into the sort of regulatory point, but from the buyer perspective, what is the likelihood that they will be able to use these carbon credits in the time frame that they're going to need them? So will there be a shift to regulatory structure or other such standards within the carbon markets, which means that the carbon credits they are purchasing today maybe at a future point in time might be downgraded or invalidated or have other kind of shifts such that they're no longer usable. I'll just finalize this comment with the statement that we often talk about risk in the carbon markets as if it is a very, very bad thing. I would say risk in and of itself is not a bad thing. Risk is an inherent part of every single thing that we do, but certainly every market that has ever existed. Risk without boundaries is what is a bad thing because that isn't risk anymore, that's uncertainty. And so I think there's a lot within the market that how do you take the existing uncertainty, put boundaries around it such that it becomes risk, and then risk can be managed, and actually companies can make a lot of money out of managing risk better than their competitors. So I'll stop.
Thanks, Natalia, for those insights. It's very interesting. Andreas, can you provide some points that come to your mind related to this regulation, risk management discussion in relation to carbon credits?
Sure, and maybe my perspective may be a little bit controversial. I think the biggest risk to the voluntary carbon market right now is that we decide to throw the baby out with the bathwater and not have a voluntary carbon market anymore. And that's a non-zero risk right now, right? When you see what's going on and the dynamics that's going on. I mean, I look at the new demand side standards from SBTi that were announced in New York during Climate Week, and basically, with a few exceptions, they disallow corporations pretty much from using offsets. Quite simply. That's a big. I mean, if that actually becomes the law of the land or the implicitly accepted normative approach, right? That's not good for the demand side at all. The ICVCM stuff, if their category specific standards aren't out yet, but if I can trust my insider friends, they tell me that, I mean, they may render a good chunk, if not the majority of existing credits non-compliant, and they're going to make it very difficult for the global south to participate because they're going to have a very hard time meeting the transparency and governance requirements that are inherent in those standards, right? And so we keep tightening market access with a focus on quality, on project quality, rather than data quality. And we call it a carbon market, but we don't let the carbon do its thing. And then the strategy of those that are opposed on many grounds to the market, of course, has been to find the bad credits and publicize them, all through Berkeley, through The Guardian, through The Atlantic. You know, it's a very, and to put fear and distrust into the place, rather than copping to the reality that the great majority of RED plus producers, for example, which are forestry producers in the world, are incredibly good faith, hardworking, purpose-driven folks doing unbelievable work under very difficult circumstances and need support. So, I think the biggest threat here is that we regulate or push this thing out of existence before it can take its rightful place in the sort of pantheon of solutions that we need.
Thank you. Yeah, that's a very interesting angle. So the risk to the market itself, in a way. Hayley, what are your points when you think about regulation and risk management in relation to carbon credit markets?
Yeah, I think that there's a lot that we don't know. I really like Natalia's point about uncertainty versus risk, and there is a lot of uncertainty in the market that it's very hard to hedge against. Uncertainty around what countries will do, around what will happen with Article 6 negotiations. This is through the United Nations Conference of the Parties process. There may be governments moving more fully into participating in the carbon market in some fashion. There may be, some people think that the compliance market and the voluntary carbon market will eventually merge. So there's just a lot that we don't know, and it will be dependent on what countries and regions decide to do around carbon taxes and whether or not voluntary carbon credits will be part of their carbon tax regime. So there's a lot that we just don't know. And I think you can speculate on that or not speculate on that. And I think we're all willing to adapt to what needs to be adapted to. So when I think about risks, I actually think about the risks of some of these emerging technologies and some of the tech that is being brought into the carbon market. I think there is a history in the carbon market. It's a 20 plus year old market, and there have been a lot of lessons learned. And I think that a lot of folks that are coming from just the technology perspective might say, oh, this seems like there's some easy fixes here, and we can just kind of jump in and throw some blockchain at it, and it's all going to be fixed. But so I would caution a little bit against risks associated with trying to find quick fixes in this market, because it is a complicated market. And I think you have to have a level of humility coming in that there's stuff that even the experts don't know very well. And some of these specific risks that we look at around bringing blockchain into the market, and we've done a lot of education for entities like the registries, like Gold Standard, for instance, and others in the space, VCMI, et cetera, around what blockchain technology can and can't help with in this market. And the things that it can't help with and that still need to be highly considered with any solution that uses technology like blockchain is that these carbon registries, you need to integrate with them. They have their own terms and conditions that they require for anybody using their credits, and they need to be brought on board for any of these solutions in order for the market to work. On the additional to that, I would say there needs to be levels of things like KYC and AML, so making sure that there aren't bad actors coming into the market. I know there's a lot of folks in the crypto space that like anonymity in the crypto space, and unfortunately that's not going to work in the carbon markets as they stand today because of requirements around transparency that are being put forward related to quality. Any solutions that get put forward also have to have really heavy security systems on them to make sure that they can't be hacked and that they don't actually do the opposite of what they're trying to do, which is strengthen the market and instead accidentally undermine it. And also, just a last point specifically to blockchain, and this is less of an issue now that the Ethereum merge has happened, but the solutions that use blockchain need to not have a larger carbon footprint than they are actually solving for. So these are all things that just need to be brought into any conversation around solutions. And I would encourage anybody who is maybe listening to the webinar because they have a carbon startup or they want to have one to consider some of these potential risks as well, and to get educated on these fronts so that any solutions that use these technologies are also solutions that can scale and that can be good actors in this market.
Sorry about that, I was muted. Thank you, Hayley. Peter, so what's your perspective on this?
It's funny. I have chats with my crypto Web3 friends, and I tell them, if you think crypto is crazy with the regulatory or wildly different regulatory frameworks and wildly different compliance regimes, let me tell you about carbon markets. Because it's even crazier here. I mean, Natalia alluded to this. You can literally have a country say, hey, you only have the land rights. You don't have the right to own your carbon credits that you're generating with the land. Or I need these carbon credits as a government to apply to my own Paris Accord agreements that I've signed. So they're not yours. That's one extreme. Then on the other extreme, it's like, there's no regulation or compliance on what you call a carbon project in some countries or most countries. There are regulated markets in some countries, and that's helping establish a baseline for that class of carbon credit. But we also want to make sure that we have this beautiful voluntary market that allows us to do all these experimental things that maybe they won't work out. Maybe, we think the science works. We think the methodology is structured in a way that will make, giant vacuum cleaners sitting on top of volcanoes suck CO2 out of the air. Do we really know? We think we do, but waiting for a regulatory or compliance framework to put their stamp of approval on that, we want to get going now. We need to experiment. So there definitely has to be a good balance of this regulation and compliance, and allowing these experimental projects to exist and permitting them to collect funding. One other link that I'd put between carbon markets and the crypto Web3 world is this is something that we need to address on a global level. The CO2 doesn't stay in the airspace of the United States or in Colombia or Brazil or the EU. And this is a global problem that we're trying to solve. So any help that we can get, the UN's doing some work, but any help we can get on just a global way to address some of this compliance and measuring of the information would be helpful. Just it's the same in crypto where borders don't matter for this stuff, so we need to come up with a shared worldwide solution.
Thanks, Peter. I think this gives a very good ending note to our discussion. I'm mindful of time, so I'm moving towards the end of this panel. So it has been a very interesting discussion with you, where we covered lots of ground on carbon credits, including market dynamics, technology and innovation, and also regulation and risk management. So there were no questions coming in through the Q&A. So we were lucky to get us some. Oh, I see some here. But I think time is already up. So probably, would it be possible that before we close, that I ask my panelists where our audience can connect with you or follow you, for example, on Twitter, in case they want to follow up on some of the discussions or have some additional question. Natalia, could you give us your Twitter account or where they can follow you?
I don't have a Twitter account, but LinkedIn works for me.
LinkedIn. All right, people will find you there. And Andreas?
Just email me at andreas@centigrade.earth.
All right, and Hayley?
Yeah, you can find me on LinkedIn or on Twitter, Hayley Moller on both platforms, just one word for Twitter.
All right, and Peter?
LinkedIn is my preferred method of communication.
All right. All right. Thank you so much. So, thanks to the audience for having dialed in. I hope you enjoyed the discussions. Peter, Natalia, Andreas, Hayley, thank you so much for having joined this panel and having provided your insights on navigating the green horizon with carbon credits and having been on this panel.
Thank you, Marcel.
Thank you very much for having us.
Sure.